International Accounting Standard 20, there is a story here on page 55. So government grants. The word government here would include NGOs, would include anybody really, whether it's local, national, any organisation that is going to give you money, you'll say thank you very much. You will apply for that money. Now, when can you recognise a government grant? You don't have to physically have received the cash, but you just have to be reasonably sure that you are going to receive the cash and you do comply with the conditions. Because a government grant will come with conditions attached. You employ a certain number of people. You do this type of research. There's a condition attached to receiving the grant normally. So you have to be reasonably confident you'll get the money and reasonably confident that you will comply with the conditions. Now, when you receive a grant, the accounting treatment depends on the reason you got the grant, the nature of the grant. If the reason you got the grant is for day-to-day running costs, training, then it's a revenue grant and you recognise it in P&L straight away. If the reason you've got the grant is to help you buy plant, to help you buy a building, to help you buy capital expenditure, then it's a capital grant, and you need to find a mechanism for spreading. You need to find a way of releasing and spreading that grant over the accounting periods that you are benefiting from the grant, benefiting from the use of the asset. So, several things worth noting down there. Recognition. It's gone. Time to go home. No, it's still 5:45. It's fine. So recognition. Thank you. So recognition. You have to be. You have to be reasonably sure. Yeah, you have to be reasonably sure that the grant will be received. You have to be reasonably sure the grant will be received. And secondly, that you will meet the conditions. That you will meet the conditions before you can recognise it. If it is a revenue grant, then you recognise in the P&L. If it is a revenue grant, you recognise in the P&L. If it is a capital grant, we need to apply the matching concept. If it is a capital grant, we need to spread. We need to apply the matching concept. Right, there's a couple of more things, but basically that's it.
I've got a question in terms of compliance.
Yep.
A question in terms of compliance, like in the course of the business we didn't comply, and then we have to reverse it. So in the case of the deferred income, would we just reverse it, or would we stop it there? And if we are doing in terms of the cutting it off from the asset, would be like, what would be the things going on?
Oh, okay. So if we think we're going to meet the conditions, and then it turns out 2 years down the line, 3 years down the line, we're not going to meet the conditions, is that a change in accounting policy, or is that a change in an accounting estimate? I think it's a change in an accounting estimate, and you deal with it on a prospective basis. You'd have to look at how much you would have to refund, and you would recognise a liability immediately. Let me address that question when I put some numbers up on the board, because when the numbers are up on the board, it might be slightly easier to see. Just three more things I want to say, really. First of all, we normally assume that we are receiving a grant of cash. What would you do if you received a grant of land? If somebody said, here you are, here is some land, how would you recognise the land? At fair value, yeah, at fair value. Because the cost would be 0. So if it is not cash, you recognise the grant at fair value. If the grant is not cash, recognise at fair value. Recognise at fair value. Now, strictly speaking, there are 2 ways of dealing with a grant that is a capital grant. But I don't want to tell you what those ways are. I want to show you what those ways are. So let's have an item of plant which cost us, for sake of argument, 20,000. Let's keep it simple and say the life of the asset is 5 years. And let's say that we have a grant that we think we are eligible for and we are going to receive, which is $5,000. So the cost of the PPE is 20, the life of the PPE is 5 years, and the grant that we are receiving is 5,000. Now, I need to stop and just stop, because actually this is quite simple and logical, even if you've never seen it before. Some of you will have seen it before, but some of you haven't. The grant is a capital grant, because the grant relates to the cost of the PPE. The reason you've got the grant is because you're buying a PPE. I think the simplest thing to do is to take the grant, debit cash, and deduct it from the cost of the asset. So that would then give you a net cost of 15, which is true. That is what it did cost you, 15. The useful life of the asset is 5 years, so you would charge depreciation of 3. I love it. It's really simple. What's the other way? Yeah, keep everything separate. Have the cost of the asset at 20, keep that separate. So you would charge 4. Keep the grant separate at 5, have the grant as deferred income, then release that to P&L 1. So in your P&L, you've got a mix of 4, and you've got a mix of 1, and your net expense is 3. So either way, you're charging 3. So I don't care which method you use, because both methods ultimately are allowed, and both methods give you a true and fair view. So before I write that down, very briefly write that down. We happy with that? Yeah. So, one method, deduct the grant from cost, depreciate the net figure. So what would that mean in reality? In your balance sheet you would have PPE, and in your P&L you would have depreciation. So in your balance sheet you would have PPE, and in your P&L you would have depreciation. Your depreciation would be 1/5 of 15. Your depreciation would be an expense of 3,000. Your PPE will be 20 minus 5, but then divided, then less the depreciation, of 3. So your PPE there would be 12. So in year 1, don't make me do every year. In year 1, if you deduct the cost, if you deduct the grant from the cost, your net cost is 15. If your net cost is 15, and then you are depreciating over 5 years, your depreciation is 3, so your net book value after 1 year is 12. So that is one way of doing it. That is allowed, that is legitimate, that is one way of doing it. The second way of doing it is to treat the grant as deferred income. The second way of doing it is to treat the grant as deferred income. Release the P&L over the life of the asset. Release the P&L to match with the depreciation expense. In our heads, we already know exactly what I'm about to do. Yeah? But it's slightly more complicated. In your balance sheet, you would have PPE, but you'd also have a non-current liability of deferred income. You would also have a current liability of deferred income. And then in your P&L, you would have depreciation, and then you would have income. I've got to get this right first time, guys. It's not difficult, it's just, it's Monday night. Everything is kept separate. Everything is kept separate. So I have an item for PPE which cost me 20, life of 5 years, my depreciation expense will be 4, and my PPE will be 16. You've got to get that one right. You've got to get that one right. There's no hope otherwise. How much was the grant? 5. How much are you going to release to income? 1. The balance of the income you're deferring is 4. How much of that 4 is current? 1. Because 1 will be released next year. If 1 is recognised in the P&L and 1 is current, how much is non-current? 3. So here we've got our balance sheet after 1 year. Here we've got our accounting after 1 year. And we've got our deferred income. Now, if we are suddenly told that we've breached the conditions and we have to pay the money back, yeah, then what would we do next year? Well, we have a liability, we've got a deferred income here of 4. If 4 is what we have to pay back, actually all I would do is credit cash and extinguish this. If I have to pay the full 5 back, for whatever reason, I would not change last year's accounts. It's not a change in accounting policy, it's a revision of an accounting estimate. And if I have to pay back 5,000, I would then have an expense of 1 to go through P&L, because I would be crediting my cash of 5, yeah, removing the deferred income of 4, and therefore having a net expense of 1. And if they charge me a penalty or interest or anything like that, obviously that would be a further expense. I'm going to give you another example just to tease you.